Good morning. I hope you will indulge me these few short minutes, because if you do, this short video very well may save you tens of thousands of dollars, hundreds of thousands, maybe even millions. Who am I, and how can I say such a thing? First, I am Baggard at StockMarketCaddy.com, and today is Sunday, September 22nd at 9:45. Now, you may be thinking that this is a chart of crypto. It is not. You may be thinking that this is a chart of NVIDIA. It is not. Or the S&P. It is not. In fact, this chart is years old. This is a monthly view of the Nasdaq, starting way back here in the early 1980s, where Bagadon and Caddy Sue were buying their first shares of stock. And no, we did not inherit a thing. We saved our money, we played the game, we lived responsibly, and we invested. We invested in tech, we invested in healthcare, and we invested in some more tech. And it was a beautiful run. And we had some wonderful opportunities to buy more, as the markets certainly had some dips. There was the crash of 87, 1994, there was the 97, there was the Thai baht crisis, and so forth. But this peak here is in 2000. The Nasdaq peaked. This is again the Nasdaq composite, peaked at 5,045. Let me see if we can see it there. No, it actually, that peak there is at 36, the high, 46.98 on a monthly basis, but it went higher. And now let me bring this in so that you can see the rest of the picture. It was right here. And I want to share with you a little history. There's the high, 5,132.52 right up here. Now, we didn't start out doing this, but as our careers got underway, we started acquiring not just the index, but individual shares of promising companies. And because the commissions were so high, $350 to get in and $350 to get it out, I consolidated, and we would try to accumulate $25,000 in each individual stock, nothing more. And yes, I held $25,000 worth of NVIDIA stock in the late 90s. I don't any longer, and you might say, what a fool, if he had only held it. But you see, we owned $25,000 of Cisco, of Intel, of a company called Sun Microsystems, Global Crossing, JDS Uniphase. Who are they? Yeah, many of those companies are no longer around. Intel, in fact, for the last 20 years hasn't gone much of anywhere. When we started to ramp right in here, I began to think that we were in a bubble. And you see, you can make money in bubbles. We absolutely did. It's very hard to understand and appreciate a bubble when you're in it. It is like being in a crowd and everybody is cheering the game on. Everyone is having a great time. In fact, in the late 90s, I can remember having these things called bag phones in our cars. Now, we didn't have podcasts to listen to or the internet chatter yet, but we would be talking with each other, colleagues, in our bag phones about the market. But in here, Susan and I, right in here, decided it was time to get out. I wanted to short the market, but they wouldn't allow it. So I can remember making a phone call and said, sell it all of it. The broker damn near fell out of his chair, pleading with me not to sell at all. That wasn't the thing to do. He was telling me that history showed that over time, over the next 100 years, the markets would go up 10% a year. Well, maybe. But as I reminded him, we owned not just the index, we had individual shares. If there is a major correction, if this is a bubble, companies like Sun Micro, I didn't know at the time, might not make it, or America Online. And there was no way to know that NVIDIA would find the same fate. It of course did not. There's always one or two. We got out. In this month, let me share with you, may have actually been a little bit before. It was late 1999. So this is January of 2000. This is actually it was in 1999, late in the year. Now this is a monthly chart. I could drill down to the weekly, but I recall getting out before the fall of 1999. And there was a little dip in the market. And I thought we nailed it right on the screws. And then the market started to rally. And it did this. And I can remember thinking, this is in February of 2000. And then it even did that the beginning of March. And I'm thinking, maybe the broker and the broker were right. Maybe I made a mistake, Susan. We better wait though. It's only been a few months. And let me now play out the rest of the story for you. The market peaked here on March 31st of 2000, the high 5132. It bottomed down here, a closing low of 1387. I think there was actually even lower, but we'll give you that. From peak to trough during that time frame, we'll put it out further, maybe even gone a little bit lower, was the decline of the index of almost 78%. Let's just round it off at 80%. Put yourself in this trade. You have $100,000 and you lose on paper 80%. Are you holding? Maybe it's $1 million. You lose 80%. You're down to 200,000. Are you holding? The .com up here, the internet was just getting started. Glasnost, the Berlin Wall were coming down. Pfizer was coming out with Viagra. There was tremendous bullishness, tremendous. The baby boomers were in their prime productive years. There were over 7,500 public companies, and yet this occurred. Now, we expected a pullback. I did when we were over here. But did I know for certain and expect that it would fall 80%? No. Fortunately, we were much out of harm's way. Where are we today? And what are they saying? So let me show you this. And I'm just trying to offer you a perspective. I'm going to change this to, bear with me, today. And we'll go 30 years back. This is still going to be the Nasdaq. And this little crash of 80% will be barely noticeable. See if we can still get it. This is right here. Do you see that? Doesn't look like much of anything, but trust me, there were folks in their 40s that are still working today who never recovered. There were folks close to retirement that are no longer with us, and it crushed them. We did not get over that high until right here. If they owned the index, that was in 2015. Think about that. It took 15 years to get back to that high. Like I say, some people died in there, and all their dreams and all their savings they didn't get to enjoy because it got taken away. And it took 15 years. Also in here, of course, was and this actually is the bottom right in here. It was right, I think it went down to about 1100. So I may have missed a couple of months. It may have been right in here in that earlier chart. But that's how long it took. Now, if you own the indices, yes, you are now whole after 15 years. But if you owned individual companies, you may have been completely wiped out because many of those companies like Sun Micro were completely wiped out or were bought pennies on the share. Now, if you happen to hold NVIDIA and happen to have held Apple through that, yes, you may have come out just fine, but maybe you didn't. Maybe you didn't own them in the first place. This is where we are now. We have this run. We have the COVID pullback, and here we are at some 18,000. It is interesting to me that up here we have the same type of candle in the fall of this year or last month, August, right in here, July and August, that little inverted hammer. Now the Fed has just cut 50 basis points. And there are all these kids, and I call them kids because they are kids with their podcasts, and they're talking about crypto, and they're talking about the bull market, and how the market is going to do this or do that, and how also they got out of college in 2006, 2007, and 2008. And it makes me giggle. Because you see, many of them, their only history is the period in which they were alive, which has been primarily this. They have no appreciation for what really happened back here. And even today, market historians and economists will disagree about what caused the dot-com and why it did that. But you see, if you even go back further in history, there's other such crashes of bubbles. I strongly suggest, if you haven't read already, one of the best old-time books about the anatomy of a bubble, and it's called, oddly enough, but really not that odd, The Madness of Crowds. You can go all the way back to the 17 and 1800s and understand the mass psychology around bubbles. I'm not telling you that this market is going to crash next month. I'm not going to do that. But we are most certainly in a bubble. Measured in quarters, I think it's near. The first move will be down and people will be in denial. They'll remember this one. It always comes back. It'll be shocking, and then we will rally back up. It'll suck in more people. We may have already done it. It'll suck in more people, and then it'll roll, and then it will crash. Now, the exact timing, nobody can know. We will have a front row seat. When it does crash, it'll be fast and furious, measured in just a few short months. And folks will be frozen. The crowd, deer in headlights. It will be great for employment because those in their 30s and 40s will have to work into their 80s to recover, and the market won't care. Will the market ultimately come back after the crash? It will. Will it be 2 years, 3 years, 5 years, 15 years, 20 years? I don't know. Nobody does. I just want you to know where we are. One of the simplest valuation metrics is from none other than Warren Buffett. And let me share a couple of notes with you. Back in 1999-2000, the most popular tech company was a company called, still here today, called Cisco. Its market capitalization, its price of shares times the shares outstanding, was about 500 billion, the largest of its time. Today, that company leading the pack, capturing the imagination of the crowd, is NVIDIA. Its market capitalization is $3 trillion. It's added 2 trillion, went from 1 to 3 in just the last year. Everybody on board the NVIDIA train. Warren Buffett has a metric, and that metric he uses to judge the overall valuation of a market. He takes the shares outstanding times the index to compute the market capitalization of the entire market. And then he divides that by the gross domestic product of what the country is producing. When it's below 100, that metric, he considers there to be considerable value in the market, plenty of room for growth. As it gets up over 100, less so. The highest reading before today was in the .com. That metric got to, in 1999, 200. And yes, they were saying back then, and we were aware of the metric, that it didn't matter, that it was a broken metric. It was at 150. It was one of the many things that had me spooked. Today, that metric is 210. 210. And the youngsters on the podcast and on the internet and on CNBC, just as they were back in the .com, are saying that, yeah, it's a broke metric. He's an old dog. It doesn't matter anymore. Maybe. So if you are an investor for the long haul, I hope you've enjoyed this little video. I hope it's given you pause. This is a great place, a great time. September 22nd of 2024, to pause, reassess the long view of where you are, of where the market is. I'm not going to tell you not going to tell you what to do or how to do it specifically. If you want to learn to trade the markets on an intraday basis, on a swing basis, or yes, invest for the long haul, you're welcome to visit our website and you're welcome to sign up for what we call our Q School. Because you see, folks, you can have the best company in the world or the most promising company, but a rising tide will raise all boats, as it's done. But a lowering tide, a crashing tide, will take them all away. Be careful. I'm Baggett at Stock Market Caddy. You can reach me any day from 9 a.m. to 9 p.m. at 813-758-8263. This video is not meant to scare anyone. It isn't. It's meant to inspire you. And I hope you stayed for the end. Good luck.